In light of the current forex scarcity in the country, the federal government is introducing measures that could ensure liquidity in Nigeria's foreign exchange market. President Bola Tinubu assigned two executive orders. First is the order that effectively allows, under forbearance, all the cash in the economy to legally come into the formal money supply. Second is the order that allows for domestic issuance of foreign currency instruments. Today on the program, we'll be talking to an economist about what this means for the forex market and the role that will be played by the Central Bank of Nigeria, as well as measures to further boost investor confidence in the economy. Stay tuned, we'll be back shortly. Governor of the Central Bank of Nigeria, Dr. Olayemi Kadoso, recently released measures to be taken to refocus the bank and restore confidence of stakeholders. And on Monday, Minister of Finance and Coordinating Minister of the Economy, Mr. Wale Edu, at the 29th Nigeria Economic Summit held in Abuja, disclosed that the president assigned two executive orders meant to ease liquidity challenge in Nigeria's foreign exchange market. For insight on these issues, we spoke earlier with renowned economist and member Governing Council, Ministry of Finance Incorporated, Professor Ken Ife. Professor Ken Ife, many thanks for joining us on the program today.
Oh, thank you for having me.
Now, when talking about foreign exchange in Nigeria, many people tend to refer to they tend to quote the Forex rates on the parallel market. Meanwhile, the CBN has reiterated over and over again that the official rate is the actual rate of the Naira. How consequential is this attitude of Nigerians, even some analysts, preferring to quote the rate on the parallel market or the black market rather than the official market? How consequential is it? Does it contribute to speculation? And how can that be changed? That attitude or that act, how can it be changed going forward?
See, the reality is this. If you are talking to the trader, the man on the street, the man that wants to use his own money to buy tickets and go abroad and then buy foreign exchange, the only rate he knows is the one that he can relate to, which is what he gets on the street. That's as simple as that. He cannot get involved in telling you that the rate, he's not interested because that is the one that he can work with. He can use today and tomorrow to buy what he wants to buy and sell what he wants to sell and use for medical treatment. But of course, if you are bringing investment to Nigeria and you need capital importation certificate, if you are paying government for something or government is paying you, government has this own official rate. If they are buying, if you are raising from M for purposes, they have the official rates. And so in that context, subject to when you get it, you fill the form and then you'll be getting it bit by bit. Now, in that domain, you can of course talk about the government official rates. So the way to avoid it, obviously that has impact because when you have the spread between the two is what actually is the arbitrage opportunity that you can manage somehow to get it in that official window and then you go over there and sell it and make a little bit of profit. Secondly, you have this willing buyer and willing seller. So which means that if you have an inflow expected inflow, the bank will say to you, come, let's talk. And you and the bank will agree a rate. The bank will not talk to you by the side on the basis of government official rate. Of course it can't, because you have a choice. So you will agree a rate that is quite high, but then you will still go to the official rate to consummate the transaction and fulfill all righteousness and tick the boxes. But then the balance is the premium, which the bank enjoys. So all of these are fueled by the fact that there are two parallel rates. But for you to end all that, you have to bring a lot of dollars into the equation, because it's a matter of demand and supply, and then try to merge these two marketplaces. So that's just my take on that.
All right, talking about bringing a lot of dollars into the marketplace, the governor of the Central Bank of Nigeria, Dr. Olayemi Cardoso, harped on the need to restore confidence of investors in the Apex Bank and the economy. What would you recommend as the steps to take going forward for the confidence of both local investors and foreign investors to be restored in the Apex Bank and in the economy generally?
There are so many elements that come into this equation. The investors want to see a predictable environment, Forex environment. They want to see a stable environment, because the instability is what speculation causes. Speculation says, oh, we reckon that in the next 2 months, this currency will lose value 20%, and then people will start scrambling to buy dollar only to go to aim to that. So they cause all that, but also policy inconsistency can also cause this. And when you have if you have independence of the central bank at risk, then that can also send a wrong signal to the investors, and they may not have all that confidence. But of course, there are other things that actually enter into the equation. If you look at 2 days ago, what the president did 2 days ago amounts to a declaration of state of emergency in Forex. But he didn't go that far. He didn't say it. But if he had said it, all the measures that he would have had to take was what he has announced 2 days ago. Now, what is this? First of all, we have seen that the Minister of Finance sees $10 billion in the line of sight, and then says, well, we hope to get that by action on both the demand and the supply. From the supply side, NNPC is going to have an increased Forex supply predicated on increased crude production and obviously likelihood of higher prices. But then you also looked at reducing demand for Forex. And you know how you can do that. The budget tries to do that. And then also you have the possibility that the NNPC should actually be thinking of reducing some of their staff and overhead substantially. You can't have 4 moribund refineries and still paying the staff for salaries and all of those. And yet you're not supporting modular refineries that could have employed some of those staff. So it is the dead weight that NNPC is carrying that is making them turn around and tell government to go and borrow $500 billion every month to subsidize. Is what they're carrying, is the headache they're carrying. So they looked at both sides, and then of course they looked at forward sales and all of that. So all of these packages are likely to bring more dollar inflow into the equation. And then of course they're talking to sovereign funds, sovereign wealth funds, to see what they can bring into the equation. So all of these measures are where they're expecting this $10 billion to come. Secondly, you've also seen $1.5 billion budget support coming from World Bank. Again, every little helps. And thirdly, we escaped yesterday. Historical escape, great escape. If we had lost this judgment of P&ID yesterday, today all of us would have been bending down our head in shame, because all the rating agencies, Fitch, Moody's, the S&P, all would have crushed Nigeria by sending our rating to near junk status, because they're going to say, well, JP Morgan said that you only have 3.5 billion in your foreign reserve. Others are committed. Now you have a bill of $11 billion. You're insolvent, technically insolvent, are you not? And that will smash confidence. If you're talking about confidence, that will erode confidence in our economy. But God has saved us. If EFCC had done well, the government has kept faith and will survive that. Although there's still going to be appeal, but not less likely to succeed. And then they're going to hear cost, which is something else. So you can see that then we now come to the other area of the speech of 2 days ago, where he now rolled out 2 executive orders. And these executive orders are on monetary policy. Would you believe? Even though we have an independent central bank, but keep that by the side. But we have 2, and those 2 have actually gone to the heart of the matter. The first one says all the cash that are in the domestic economy, and then by cash you mean whether a dollar or yen or whatever that are in the domestic economy, in domiciliary account or wherever they are, that they should be in the real economy. They are now going to be considered to be in the formal economy. So what it means is this, is granting statutory forbearance, as we did during 2020 COVID, when CBN granted statutory forbearance to the banks to restructure the loans, to reduce the interest rate to 5% from all of that thing that they did, is doing exactly that now. To say, okay, over some period of time I haven't defined, I want you to relax all these regulations, all these pigeonholing and sequestration of different accounts. And then, you have domiciliary accounts. You cannot move dollar from there, use it to pay people on this account. No, you have to be foreign inflow that you will use to pay. All that is pushed them aside. So let us deal with a state of emergency. And that emergency is what we are saying is what is. So the second one, of course, deals with the domestic issuance of foreign instruments. And that is fantastic, because it now means that Nigeria can, some players in Nigeria can raise, or even Nigerian government can raise $20-30 billion of foreign instruments, and then then give them a confident good rate, which obviously you may have a sovereign guarantee on that. Now that means that the diaspora that are bringing 26 billion may decide to bring 50 billion. And then buy those bonds. And if you look at all the bonds we raise, are usually 400% oversubscribed. So if you do that, the money can come on shore. You can now have these billions come on shore. And then you can now deal with what I call the consumer credit that he alluded to in his first speech, which is how do you support the industries by encouraging dollar inflow to help them import what they need, and then also enable the buyers who want to buy their products to take higher purchase or lease purchase by dropping 10% or 20%, and then the rest of the financing is done by that program. So that means that you can allocate substantial money from there. If you take motor industry, let's be practical. If you take the automobile industry, if you say that the automobile industry in Nigeria are doing only 10,000 cars a year, okay, but you have an allocation to the automobile industries of, let's say, $200 million, then fine, you can allocate that to them and they will use it to purchase all their equipment and all the things they're assembling. If you put 10% down, it drops. And then you can now pay the remaining over 3 years. But what does that do to our economy? 400,000 cars, second-hand cars, come into Nigeria through Cotonou. If you take an average of $10,000 per car, that is 400 million. 4 billion. It's $4 billion. Now, all that market will go, because when you drive off with a car, you assembled here, a year after you bring it and it becomes second-hand car, and you drive off another one by putting it as a deposit. So you now open that flow. That manufactured assembling car here can now do 100,000 cars instead of 10 cars. You are now creating 10 times more jobs, and you are displacing the $4 billion that are being sought from wherever they get it from black market to import all those cars, second-hand cars. Can you see the benefits? Our companies grow in multiple. Jobs grow, consumption here. If you want them to do armored car for you, and you place order for 200 armored cars for members of the National Assembly, they have enough dollars in their stock to buy the armored sheets. So you energize the economy. So this is what this opportunity has brought in, and then we can make sure that there is more fiscal policy aligning and coordinating with monetary policy and trade policy for this to work out very well.
All right. I'm glad you have explained all of this consumer credit of a thing, but it has also thrown up about 2 or 3 more questions. The first question, what role will the central bank play in facilitating this, if you can spell it out? And secondly, there was a time in this country, in the history of this country, that consumer credit was the order of the day back in the 80s, but it failed. What lesson can we learn from that so that when the economy allows for this consumer credit thing to thrive, it doesn't fail again?
Okay, the consumer credit, if you notice, I'm very careful about not saying bring the consumer credit and everybody will take it and go and buy anything they like in shops. That will fuel inflation. The reason is because if you create those consumer credits and they use it to buy imported goods, you have worsened the problem because you are going to create more inflation. You are going to still have inflow of the inflation pass through to the consumers. But if these credits are targeted to manufacturers who really need the dollars for what they want to do, and it is tied to the economy, to the consumption of locally made goods. So what you are doing here is that you are increasing output, domestic output, and you are increasing domestic product consumption. And so the economy grows. Then if you come into the housing arena and somebody borrows money to build 1,000 houses, then you can refinance it. And then what then happens is that they can collect 80% of that money. You who is buying can drop 10-20%, and then it goes on building more. And then you can now patiently sell. And then as you build more, you're creating more jobs. So it is all, if you direct it, target it to the domestic economy to increase factor productivity and at the same time support domestic consumption, then it's a win-win. But if you allow that to go to fund shops that are importing cosmetics and all that kind of things in the market, then you're going to have more trouble on your hand. Then what was the other side, the other issue that you wanted me to...
The role of the CBN in facilitating
that. Obviously, if you want to enter into this lending equation, CBN will have to grant you a license. You see, and CBN has been very generous because it has been supporting the funding of the payment infrastructure. It has brought in telcos and licensed them to get into the payment. It is doing all that to expand the base and not just listening to the commercial banks who are just one of the stakeholders, but opening up the space. And if Central Bank has not done what they did on improving payment infrastructure and bringing agency banking, supporting agency banking, licensing, and doing all that, we would have been in serious trouble during the COVID. But look at it, during COVID, our ICT sector and the banking sector were growing at 18%, 16%. And yet we were sitting at home using Nokia to do financial transactions. We were all locked down, but these guys were making money. When we were locked down, many economies were in serious trouble. So there were some gains.
I can see optimism. Some people are not seeing optimism, but I can see optimism in your analysis and in some of the actions that have been taken. And I believe that should bring some succor to people who are troubled about the current state of Nigeria's economy. I must thank you very much for your time and your insights. Time wouldn't allow us to go into what your expectations are for November Monetary Policy Committee meeting, but there will be time to talk about that some other.
But what I have to say to you about the new Monetary Policy Committee, you now have the orders are now being rolled out by the president. So the committee has agenda, serious agenda, because you have to think about how do you give administrative effect to some of these new executive orders. You know, he's issued them. We have to take them back and then look at what it means to banking supervision, what it means to our prudential guidance. We have to domesticate them and then ensure that you give them administrative expression. So there is a lot more work to be done now with all of this.
The leadership has gone to work on that, and we'll begin to see the result very soon. Many thanks for your time and your insights, Professor Ken Ife.
Thank you.
Africa has had a difficult year in 2023, but with sound economic policy, there could be light on the horizon. In sub-Saharan Africa, growth is expected to decelerate for a second year in a row to 3.3%, down from 4% last year. Slow international demand, expensive and difficult access to finance, and exchange rate pressures are still hampering recovery. But despite these challenges, many countries worked well to weather the storm, and 2024 looks brighter because of this. Growth is set to rebound to 4% in sub-Saharan African region, with most economies projected to grow. Still, it's too early to celebrate. The region will continue to face a difficult environment marked by still elevated inflation, high borrowing costs, continued exchange rate pressures, and fragility, all while working to enhance income levels. 4 policy priorities can help address these challenges: fighting the still ongoing inflation pressures, increasing exchange rate flexibility, reducing debt vulnerabilities, particularly by mobilizing more domestic resources, and eliminating the factors that are constraining economic growth. As countries are facing a range of exogenous shocks, authorities must find ways to reap the benefits of previous investments to create space for more development spending, allowing the region and its people to reach their full potential.
Oh, I see. Just hold on. In that case, let me call out my PIN. It is 41.
Uncle, please stop.
Stop what?
You're giving someone else your personal identification number PIN?
Not someone else. It's from my bank.
Please hang up, Uncle. That's a fraudster.
That's not true. But they call out my full name. I am sure this is from my bank.
Uncle, no bank is ever going to call you to ask for your personal identification number PIN, your mobile banking password, or your card verification code, CVC.
But it sounded so genuine.
Yes, hackers and fraudsters always sound genuine. But please, Uncle, don't fall for their bait. Don't respond to any phony emails, text message, SMS, and don't click on any link you're not sure of. Even if they call your date of birth or your BVN, don't give them your security details. If you suspect any issue with your account, please go to your bank.
Oh, I see.
This message is from the Central Bank of Nigeria.
That's the package from the CBN this week. Be careful not to fall for any fraudulent recruitment portal or loan scheme advertisement purportedly from the Central Bank of Nigeria. Get your information from trusted sources always. Report unresolved banking issues to the CBN Consumer Protection Department using the email cpd@cbn.gov.ng. Attach relevant documents. Call the CBN Contact Center on the phone line +234 700 2255 226. Local call rates may apply. Write to us through the email address from the cbn@gmail.com. Follow us on Facebook, YouTube, Instagram, and x.com, formerly Twitter, for updates and to watch up-to-date episodes of the program. We invite you to join us again next time. I am William Misi Dada. Stay safe and bye for now.